All right, good afternoon. This is Mike and Jennifer with Summit Financial Partners and doing another Facebook Live event today. And today we are talking about market timing, I guess the cost of trying to time
Yeah.
investments in the market. And this topic has come up just because we typically will get this question from time to time. And recently, with such a strong bull market that we've had in the last several months, that people start to get a little bit uneasy and start to think that maybe we should think about timing the market and pulling our asset allocation back, that something may be happening in the near future. Just because it's been so positive, it can't go like this forever.
Right.
Something's going to happen, and we don't want to be a part of the downturn. Should we draw back our asset allocation? Should we be a little bit more defensive? That's a understandable thought, if you are kind of thinking that I want to time the market, and I'd say everybody's guilty of it. Advisors, just the same. That we want to think that something's probably going to happen soon, but there's some really detrimental costs to taking that kind of approach, and we wanted to talk about that, supported by some data and some real hopefully logical arguments behind that instead of the emotional side and trying to time that.
Yeah. People do make most of their decisions emotionally, not logically. So we'll hopefully provide some of that logic framework around it. So a couple of things to think about as we approach this topic is, one is there's really no top to the market. The markets are very high, especially U.S. markets, and we're just part of the world. There's lots of other markets out there. But there is no top. There's no point at which it cannot grow anymore. That is not to say the ride up will be smooth. We know it won't. That's just the way it works. And it's actually quite normal to have a correction of about 10% every year. So it's not unusual. It seems to be a little less unnerving to people lately when that happens, but we haven't had one like a normal 10% correction in a while. Now, a year and a half ago, almost, we had a pretty severe correction, or really it was not even a correction. It was just the bottom fell out because of the worldwide shutdown of economies due to COVID, the spread of COVID. So, and some of these market pullbacks are more severe and more severe than others, and some you have an obvious reason, like COVID or the financial crisis of 2008, when many people had borrowed more than they could pay back, and there were some big things going on with the insurers, and Lehman Brothers went bankrupt, and it's I still call it the Lehman Aggregate Bond Index, and it hasn't been that for a long time. And sometimes the reasons are more subtle, and sometimes it seems to be no reason at all. It just could be computer trading, or some fears grip the market. People get worried about presidential elections. Lots of different things that can happen. And so the range of corrections is quite wide, and the reasons behind them are quite varied. But the main thing to remember is it's rare for any correction to not have been recovered and grown beyond within a year. It's unusual for a recovery to take up to 3 years, is the longest one really in recent history, which was in the 80s, actually. So we do understand your concerns about the market, and we know our world's still dealing with the after effects of COVID, and there's so much turmoil going on in our country and other countries, and it makes us all uncomfortable. No matter what side of any issue you're on, it's uncomfortable, and people are worried. So it's definitely a valid concern.
Yep.
But the data will tell you.
Yeah. So one of the charts that we wanted to pull up so that you could see is this chart here on the cost of trying to time the market, and that philosophy or that thought exactly that we were just describing there, just to show that the data that we're working with here is the hypothetical $1,000 of investment that you invest into the S&P 500 at the beginning of 1990, and you leave there all the way to the end of 2020, so December 31st of 2020. So it's a 31-year period that we're investing this $1,000 into the S&P. Now you can see with the top the bar graph there that your $1,000 would have grown to $20,451. As we kind of go down the chart, you start to see the impact of trying to time the market. And what's really impactful here is when we're talking about timing the market and what people are actually doing, they're taking money out of equities, out of stock for an extended period of time.
Right. Because they think it's going to go down.
Right.
Yep.
Right. So what this second bar chart is showing is actually missing one day. Now it is the best performing day in that 31-year period, but just to show that when that best day actually happens in any kind of time period, that's a gambling game. I mean,
Yes.
there's nothing else. Yeah, and we went through before today's video to look at some of those top performing days and when they were. And even still looking back, we're trying to put logic behind, why one day was so great. And sometimes it's right after a dip, and sometimes it's right before a dip. Like when those actually happen, there was really no predictable evidence, even looking back now, that we could say, oh yeah, well that's why that day was so great. So as you can see, that first bar chart there, that $1,000 would have grown to $18,329. So you missed out on over $2,000 of growth. By missing one single day in that 31-year period. And as we go down, it just gets more extreme. I'll just point out the bottom one is missing the 25 best days in that 31-year period. Your $1,000, instead of growing to $20,000, over $20,000, would only be worth $4,376.
Less than a day per year.
Right. That is. I did the calculations. That's 25 days out of 7,843 market days in that 31-year period. So your money is invested for 99.7% of the time.
And you still, wow.
And you're still, and that's the kind of amount you're missing.
Yeah. And most people aren't investing just $1,000,
I was
right?
going to say that. Yeah. So to kind of put that into, I guess, more realistic numbers there. If it's not uncommon for somebody to have $100,000 invested, or more. But if we say $100,000 and we take that $100,000 and invested it, I'm really just adding zeros to the numbers here. And we had to double check ourselves when we first did this because it seemed crazy. But if you invested $100,000 in 1990 and missed the best 25 days. You would have missed out on $1.6 million of growth.
Now that is a much more meaningful number,
yeah,
isn't it? That's painful.
That's nuts. So yeah,
that
saying that your money's worth $4,000 instead of $20,000, that's the cost of a cheap car.
Yeah.
But when we're talking $100,000 invested, you're missing out on $1.6 million of growth by missing 25 days. It's just 25 days. So that's the potential cost to trying to time the market. When we say detrimental, I mean that's beyond detrimental.
Oh, life-changing.
Yeah.
Life-changing, for sure. And bear in mind what huge events happened in that 31-year period. We had the Asian contagion and the long-term capital management implosion, which blew up the markets in 1998. We had the dot-com crash in 2000. We had the terrorist attack in 2001. We had the financial crisis of 2008. We had the U.S. downgrade of debt in 2011. And we had what just happened in 2020 with the COVID shutdown. And those are just the big ones. Yeah. There's lots of lesser magnitude ones that have happened. So this fear and concerns we have about what's going on in our world today, there really isn't a time in our world where we don't have some big issues going on, unfortunately. But so just kind of bear that in mind. And I think too, one thing that is not always in the forefront of people when they're trying to tempted to time the market and say, I'm getting out of stocks at least a little, is that you have to be right twice. You have to know when to sell. Let's say you sold at the top. Then it's like, when do you get back in? And we still to this day have talked to people who got out at the bottom of the market in 2008 and never got back in.
Yeah.
And they've missed this huge bull market and over decades. I mean, they've lost life-changing amounts of money.
Yeah.
by that, and so by not getting back in. And so as painful as the corrections can be, you're better off just kind of maybe not opening your statements for a few months or logging in for a little bit. We do want to talk about a couple of things of real actions that can be taken. First of all, if you have a life circumstance that requires an asset allocation change, a change in equity allocation, that is a different issue than fear.
Yeah.
And so that is something that definitely to consider. And occasionally we have clients that do that. They have there's a very good reason why we would change their mix of equity to bonds.
But it's never market related.
No.
It's always life circumstances.
Yes. And I so vividly remember many conversations when that conversation has happened while the markets are down. And we're like, absolutely, but let's wait a little while till the markets have recovered. Yeah. And then we go ahead and switch it. So if someone were to come in here today and wanting to draw back their equity allocation for life circumstance reasons, we'd be like, this is a good time. The markets are up for sure. So it's not a blind following, but it's not timing, it's life circumstance timing. So the other thing to do is it's sort of like mini timing. I don't know. Is rebalancing. And rebalancing is, in our portfolios anyway, we have a set target that we want to hold of stocks versus bonds. And within each of those portions of the portfolio, how much in each fund or kind of fund that we want to have. How much do we have in the U.S.? How much do you want to have internationally? How much in the small companies versus large companies? And if you have a very specific target, you can see when things get out of balance. So what happened, this is an extreme example of it, but in March and April of last year, it was really about the third week of March in 2020, when the markets were down, we said, oh, we need to rebalance and we need to sell bonds and we need to buy stocks. Because even though the markets are down 40%, this is as bad as it got in the '08 crisis, which was huge. And it might go down some more, and it might take a year and a half to recover. But right now, we can buy stocks on sale. So we didn't sell everything, but we brought everybody back to their target and bought into the equity markets then. It's a little bit of a contrarian move, and people don't like it because they're like, what are you doing? You're buying into a down market. But it does pay off. But you stay within that set philosophy and that set asset allocation that you've already determined together with your clients, and it does help. And so your long-term returns over time are better. So I didn't think the markets were going to recover as quickly as they did. So it was very exciting when they did. But we were ready for a long haul recovery at that point. And still our economies are not fully open, but the stock market hasn't acted like you would expect because it is not predictable.
Yeah. And in our periodic rebalancing and sticking to an asset allocation, after that March rebalancing where stocks are way lower than bonds, which prompted us to buy stocks.
Yeah,
going to rebalance.
It was really fun.
It was the opposite several months later when we go in and constantly, like what was a couple of the funds that we were selling a ton of.
Yes, we were like targeted value, which was an asset class that actually hadn't been dripping along for a while, but it was medium to small companies that suddenly just took off at the end of last year, and some of the international allocations. Yep. And so so then we ended up paring back some to get it back
right back to the bonds. Yep.
You have to have a methodology to it all.
Yeah. So, we have this video that we wanna link to or share. We'll figure out a way to get it out there. That is one put out by Dimensional Funds, is the fund family that we use, and he uses this cool illustration where he's kind of just talking about timing the market. It's like gambling, and I saw another analogy in trying to time the market is like standing at the roulette table and seeing that the roulette ball has landed on red for the last 30 moves, however many, that black is due. People always say black is due,
but the odds are always the same.
The odds are always the same, because it has landed on red so many times, it's more likely that it's going to land on black, and that's just not true.
It seems logical. It does.
So that's the same thing that people are doing here is we've been positive for so long, we're due for a correction, we're due for something to be negative.
Yep. And the guy in the video is Ken French, and he's a very famous researcher in the world of investments. And their models, the Fama French model, and he's a professor in Princeton, and I definitely recommend you listening to him. He's good.
Yeah. If you don't believe us, listen.
Listen again.
Yeah.
So, well, thank you for joining us. We hope that was helpful. We welcome your questions. You can email us at info@summitrva.com. We'd also love any ideas of things that are on your mind that you would like us to talk about. Yep. And we're open to pretty much any financial topic that is on your mind.
Yep.
So please let us know.
Yep. Thanks.
Bye.